听见资本本期视频为您带来的是摩根士丹利在4月1日关于锂电池行业观点的闭门会内容。锂市场正处在一个关键转折点，这可能直接影响你的投资组合或业务决策。你知道吗？当前低迷的价格正让不少生产商陷入困境，甚至亏本运营，这背后隐藏着哪些风险？电动汽车在中国高歌猛进，但为什么锂需求的增长却可能不如预期？磷酸铁锂电池的主导地位又意味着什么？同时，来自非洲等地的新增供应虽然来了，却伴随着质量和稳定性的疑问，而锂灰石价格的下跌正压缩整个产业链的利润。美国的新政策一边试图加速本土矿产开发，另一边却可能通过关税推高电动车成本，这对全球供应链有何冲击？更值得警惕的是，专家预测，眼下的供应过剩局面可能在未来10年内急剧逆转为严重的供应短缺，这又将如何引爆价格？接下来是英文会议的全部内容，将为你深度剖析这些市场动态和潜在的巨大波动。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello all, good afternoon and welcome. I'm Rahul Anand from the Australia Materials team and I have with me today 3 speakers from S&P. We have Leah Chen, who's the editor in the lithium space and will discuss the latest in the markets. We've got Alice Yu, who's part of the research team at S&P, talking about forecasts today in terms of lithium and how they're thinking about future period prices. And then we've got Mun, who's also part of the research team, but is heavily focused on the ESS side and also the executive order in terms of domestic mineral production and tariffs in the auto space. Look, before we begin today's webcast, I just want to remind people of the format. We'll begin with some introductory comments from our speakers today. That'll last about 5 to 10 minutes. During this time, feel free to send your questions through. The way we're taking questions today is through the Q&A dialog box in front of you on the screen, and I'll pick up your questions as we step into the Q&A section of the call. Importantly, this webcast is being recorded and is only for invited participants, so those would include Morgan Stanley institutional clients and wealth advisors and any other invited corporates. If anyone from the media is dialed in, I do request you to please disconnect now and to reach out to me separately. With that, I'll also remind everyone that we'll have about 30 to 45 minutes for this call, but we've allowed up to an hour if we have pending questions that we need to address, and that'll be the hard stop. So look, with all that out of the way, thank you very much all for joining me today. Perhaps the talking order for the introductory comments today is Leah first, Alice second, and Mun third. Thank you. Over to you guys.
Yeah, okay. So as Rahul have introduced, my name is Leah. I'm the team lead of Battery Metals team and part of the pricing team. And together with me today will be Mun and Alice, who will talk about the forecast aspect of things. So I will just kickstart. Yeah, so for my portion, I have 3 brief slides to share on the spot market side of things. So as you can see from this chart, throughout Q1, we saw that the Chinese lithium carbonate prices are more or less range bound, roughly trading between 73 to 77,000 yuan since the Lunar New Year period until now, with some slight fluctuations up and down. As you can see here, the red line, which is the lithium carbonate, prices have been trading at a premium over hydroxide. And we do see that this is the trend since 2023, when the market saw a huge shift towards the LFP batteries, which mainly uses lithium carbonate. And the trend continued to persist until today, with LFP batteries consistently occupying about 70% of the market share in China. In terms of supply, we do see that it seems rather stable at about 18,000 tons of lithium salt production per week in China. So that'll be roughly around 72 to 74,000 tons per month domestically. I would say that partly it's also because of increasing supply from the salt lakes in China after the wintry months. But we do see that back in February, CATL had also restarted their lepidolite operations in early Feb. And we saw that in their most recent mid-March financial report, they also shared that their Jiangxi lepidolite mine is actually able to operate without loss, and its cost of production is below the current battery-grade lithium carbonate spot price. So that would imply that its current cost of production was roughly below 75,000 yuan. There were market talks that their cost of production might be higher at around like above 80 to some even put it closer to 90,000 yuan because it is after all a low-grade lepidolite mine. But yeah, based on their own report, it's below cost of production. And we do hear that some of the cathode producers in China, they're still running on excess inventories that they stock up prior to the long Lunar New Year holidays. And some have shared that they still have about 2 to 3 weeks worth of battery cathode inventories. So to be honest, there's no rush for them to procure from the spot market right now. However, on the demand side, we do see that cathode orders in April seem to be a bit more positive. Market is expecting cathode production to increase by 11 to 12% month-on-month basis, which may drive demand for the raw materials. I'll go on next to the seaborne market. So for the seaborne market, the demand has been rather muted, I would say, amidst the slow downstream demand from both Korea and Japan. So currently, about 80 to 90% of the seaborne materials are tied to long-term contracts, which have been sufficient to meet their demand. So that has also contributed to thin spot liquidity. Recently, some of the South Korean battery makers have also shared that they have and they are holding high battery inventory levels, which discourages spot trading altogether. We've also heard in the spot market that some of these excess long-term contract materials are also taken to the spot market to be sold back to China. So so I would say definitely most of them are sufficient on long-term contracts. Many of the market participants are still watching the Chinese domestic lithium markets very closely for some clearer price direction. In terms of prices, it's following a similar trend to China, I would say, with the red line, lithium carbonate, trading at a premium over the yellow line, which is lithium hydroxide for most of the time. This is because some of the South Korean battery makers, they've also shared that they are changing their battery-grade lithium hydroxide capacity to switch to producing carbonate. And these lithium carbonate will feed into mid-nickel batteries as well as some of the newer LFP batteries in Korea. So definitely, we also see that this changing or shifting battery chemistry preferences towards LFP and away from NMC does drive higher demand for lithium carbonate. And lastly, on the upstream lithium spodumene. So spodumene, we understand that it's still the main feedstock for lithium chemicals. And it makes up about approximately 60% of the raw materials mix for lithium chemicals. And we do see that the spodumene prices are also following a very sharp drop because of the weak chemicals prices this year. And in part also probably due to higher supply, more supply of spodumene coming from not just China, but also Africa, Brazil. So for example, just yesterday, Sigma lithium spodumene concentrate in 2024 had reported more than double year on year based on its 2024 results. I think it was at 240,000 tons for the whole of 2024. And currently, in the spot market, we also do see that a lot of the spodumene concentrate is being offered. So the latest in the market is, I think just last week, there was one cargo, 30,000 tons for 5.7% grade coming from Brazil, offered at 810. Yeah, so based on the current spot market situation, Platts' current assessment is at $800 for SC6 basis. And if we do a simple calculation, that's roughly equivalent to about 74,000 yuan in terms of cost of production. And this is inclusive of the processing or tooling fee of about 25,000 yuan. So if we take a look at the current spot market price of lithium carbonate in China at 73,800, producing or procuring spodumene at 800 will mean that the converters will be producing at a loss. So the low chemicals prices, and I would say that the negative profit margins had definitely placed significant pressure on spodumene prices in Q1, causing, as you can see here, the spot prices to move down further. Yeah. I would now pass the time over to Alice to speak about the forward-looking market.
Thanks, Leah. Just before we put Alice on, just one follow-up there quickly. The $800 a tonne assessment of SC6 price that you just mentioned, that's delivered into China?
That's FOB Australia basis.
Got it. Okay, perfect. Thank you for that. Moving on to Alice now. Thanks.
Yeah.
Thanks. I will take everyone through the outlook, and in the middle, I'll pass over to Mun. Okay, next slide, please. Yeah, so first off, starting off with EV demand. So we use the term PEV, and that includes both the battery electric BEVs and the plug-in hybrids vehicles. So all vehicles that you can plug to an external electricity source to recharge. So a recap of 2024, China's sales rose by an impressive 41% year over year, and penetration rate is just below 50%. And that increase puts China further ahead as the world's largest passenger PEV market. And this year we'll see uptake surpassing that 50%. So it means more than like 1 out of every 2 vehicles sold in China, new vehicles, they will be a PEV. And that contrasts to a slowdown in sales in the US and even a decline in the EU. But the share of the pure battery electric BEVs within the sales mix has been declining in China. So currently, in a single month, around 55 to 60% of PV sold, they are BEVs, and that is 5 to 10 percentage points lower compared to 2 years ago. And in China, BEVs on average have a battery size that's twice as large as PHEVs. So that means with the shift to the plug-in types, like the battery size on average is halving, and half of lithium and other battery metals will be needed in these cars. Next slide, please. So far this year is off to a good start. January and February PV sales across the key markets have increased, but for the rest of this year, there are like just significant amounts of uncertainties. And you can see US consumer confidence has started to weaken, and they were already weak in China and the Eurozone. And with the uncertainties, they are likely to have further negative repercussions on household income and consumption, which really drives the demand for EVs and electronics. Next slide, please. So as Leah mentioned, the lithium refining margins are in the negative territory. So we look at the merchant refinery margins. So these are if the refinery procure their feedstock from the spot market, and they're negative for Chinese refineries who use both lepidolite sources domestically or using imported concentrate, spodumene concentrate sources. And then we looked at the earnings of Yongxin, which is a key lepidolite producer in China. They've held their production volume in 2024. It slipped marginally, but operating margin fell to 37% from 72%. And only in 2022, it was at 87%. So that's a quite significant drop. So there's, and then the fall in operating margin, it comes from a bigger drop in lithium prices, and also the company's unit cost fell. So I think we're using this example to shed light on what's happening to the integrated lepidolite producers in China, that their margins are falling, but they're also lowering their cost to help. Next slide, please. So as Leah said, the spodumene price has dropped more significantly recently. And then up until around March, actually, lithium chemical prices fell sharper than spodumene prices. And that's why all the pressure was on the midstream, on the refineries. So they've just started correcting, and the spodumene price fall is catching up. But even so, we're just talking about the relative price drop, and there's still significant pressures on the lithium extraction industry. So taking a price of $9,200 for lithium carbonate for Asia, on that price assumption, which is the lowest price experienced in March, around a quarter of lithium extraction operations are loss-making on a total cash operating margin basis. So this is cash margin, including royalties. So where prices are now is really calling for more supply cuts. Next slide, please. And looking at lithium supply in more detail, so there still will be supply growth this year, and that'll be led by Argentina and Mali and Africa. Australia is going to be the third largest contributor, and that is because of project ramp-ups in Argentina and Mali, Mariana brine, and in Mali, the Goulamina and Bougouni, which started up in recent months. And then looking even more into the long term, lithium supply will be more geographically diverse. So aside from Argentina, Africa, North America is set to emerge as a major production base. And by 2035, Canada will account for 53% of North American supply, and the US 41%. And these supply increases will come from hard rocks in Canada, and in the US, clay, geothermal brine, and some oil-filled brine. Like breakthrough in extraction technology will help realizing these novel deposit types. Next slide, please. Now, looking back into EV forecast and the demand side, definitely short-term challenges related to EV demand, like how long the US EV tax credit will last, and all the tariff barriers that are also delaying the drop in EV prices for the consumers in that location, because governments are using the tariffs to protect jobs in their automotive sectors. But despite these challenges, we remain optimistic about the longer term uptake. There will be an ever large range of EVs to choose from. Charging is getting rolled out, and improvements in battery technology will deliver higher capacity, longer range, and faster charging. So these ongoing technical developments will help to lift uptake, and global uptake will surpass 50% from 2033. In terms of battery chemistry mix, LFPs will dominate. They'll drive the mass market EV models. And there will be, that the rise in LFPs will be at the expense of some of the nickel-containing chemistries. Next slide, please. So looking at EV penetration in more detail, we expect EU to approach 100% by 2035 because of policy directions. China to in like between 80 to 90%, because China doesn't have this policy direction, and some colder regions in China, more sparsely populated regions in Western China, they all naturally inhibit the shift to 100%. But China probably will get pretty close even without the government mandates. And the US, we have it over 50% penetration rate by 2035. And looking at the share of demand by end-use sector, the passenger PV sector will dominate and reach 68% of total lithium demand by 2035. The other major growth sectors are the other vehicle types. So that includes commercial vehicles, like all the batteries that gets used in the various types of hybrid vehicles. And finally, energy storage. And all three of these sectors, so passenger, EV, other vehicles, energy storage, they'll grow by roughly the same CAGR rate, so low double digits. And energy storage will also keep its share of lithium demand around 12% because it's growing at the same rate as the other two sectors. So staying on this page, I'm going to pass over to Mun to give a bit more color on ESS and the US.
Right. Thanks, Alice. My name is Mun. Hello, everyone. Before I walk you through the next two slides, I'll just speak very briefly on energy storage systems. Apologies, we don't have a chart in this slide deck. So ESS remains an important part of the lithium demand, accounted for 11% of total lithium consumed last year. And the forecast at S&P is that this demand grows at 13% per annum through 2030. So it's a space that we continue to watch quite closely. So moving on to slide 15, please. Okay, the chart on the left shows U.S. vehicle imports. This is split between PEV and non-PEV. So imports of light vehicles accounted for about 48% of U.S. sales last year. So it's a big proportion. And on the right, you see where the U.S. is importing its vehicles from. Roughly 40% of light vehicle sales last year were from Mexico, Canada. So the proportion that is non-USMCA is significant. So the takeaway from this chart is that tariffs, the latest tariff announcements will be significant for U.S. consumers in terms of the sticker price. Moving on to slide 16, please. Okay, this chart, shows average development times for mines worldwide. The red shows what the lead times were like in the late 2000s, and the black shows lead times in the 2020s. Clearly you can see that lead times have increased for all three phases of mine development, from exploration and studies all the way to construction. So the executive order on March 20th introduces several initiatives, and I'll speak on two today, which we think will address the issue or the challenge of longer lead times. First is expediting the permitting process. We know that the government's going to identify which projects are a priority, and these will be accelerated. So there's going to be, I think, quite a lot of low-hanging fruit. This clearly will boost mine development in the U.S. And the second initiative is the prioritization of federal land for mineral production. Projects on federal land are known to be more complicated due to the involvement of multiple agencies. So the fact that the government is going to prioritize this, as well as make it more transparent, there will be a permitting sort of a dashboard that is open to public for tracking, accountability, and transparency. So I think these two initiatives in the most recent executive order will be positive for mining projects in the US. So that ends my comments. Back to you, Alice.
Thanks. I'm going to walk over the last slide we have, which is our lithium price forecast. So the left-hand side is our quarterly forecast to 2026, and we are forecasting the price to stay below $100,000 a ton for lithium carbonate CIF Asia basis, and the price will actually dip in Q2 and Q3. That is because we do anticipate more news of lithium curtailments to happen. And so this price dip coincides with that anticipation. And when more cuts do materialize and bring down the market surplus, then there will be some respite, some momentum for the price to ease its way up. And looking out to the 10-year, 2035, so we forecast the market to move back into a deficit in 2033. And then you can see the deficit is then actually quite stark. So again, we are moving from a cycle of too much supply today and then not enough in the foreseeable near future. So for the price wise, expect the 2035 price to be around $20,000 again on a CIF Asia carbonate basis, and that marks the end of the prepared presentation.
Brilliant. Thank you, Alice, Leah, and Mun. Audience, this is the opportunity to ask a question. So the way to do that today is via the webcast service. You can send your questions, type them in the Q&A dialog box, and I'll pick them up as we go. So team, I might start a few of the questions. Maybe we can stop the screen share at this point to go full screen again. So look, I guess the first question that came through while you were talking, in my mind at least, was, can we talk a bit about that Carol mine restart, right? There are some people in the market that view it as a positive in the sense that it's potentially indicating strong demand, and Carol's incentives are perhaps to keep a cap on pricing in the lithium market, and that's potentially the driver of that happening. I guess, how are you seeing that restart, and sort of any extra color you can provide on that would be great.
Maybe I can take this, and then if Alice or Man have anything to add, feel free. So we do have a bit of, I would say, diverse market opinion with regards to lepidolite mine restarting. Because based on CATL's standpoint, they are restarting their mine because they shared that demand is picking up in March as well as April. So they are restarting their mine ahead of the anticipated increase in demand. But we do see that from other market perspective, is that if their lepidolite mine is operating at the current market level, then there's really not much incentive for them to operate at like break even or perhaps even going into a slight loss. So the general public sentiment that we heard from other market participants is that they've received some pressure from the Chinese government because they want to rely on domestic resources. That's one. And there's also market talks that they have received some incentives, perhaps in the form of subsidies to their power costs, etc., to continue operating their mine. So that could be another facet to why they were operating. Hopefully that answers the question.
I can add a little bit more to what Leah said. So I think one when a lot of us heard the news, there was kind of a bit of shock because the mine closed down, suspended production not so long ago because of it's not profitable. But the prices fell through these months. Why are they restarting? And in relation to what Leah said about China wanting to produce more domestically, I think another color is the power of controlling your resources, because earlier we showed that there's a power to integrated resources. So you can control the cost, and then you can manage supply in relation to your demand. CATL produces batteries. They want to have stable supply. And then all the producers now, they're cutting cost. So I'm not surprised if costs are down. I don't know how they're going down, but they're going down for CATL. They're making money right now, and they could source externally, but it's very risky now because their source could go out of business, and then they'll be left out in the cold. So I think control is key.
No, understood. That's fair. Okay, let's move into a different part of it. I'm sure Leah perhaps would have a bit to talk about this, but African supply. Obviously, we had new projects, Begoni's coming online, and we're basically seeing supply come on from Africa despite prices where they are. And then if we think about last year, I remember there were murmurings or chat in the market that, there was basically African product being stockpiled and only the high grade product was being shipped and, to allow for economics. So I guess in all of this, what I'm trying to understand really is if you have perhaps a clearer handle on where you think some of these African mines, costs are sitting, and if there's any pressure that these costs might actually rise, because it sounds like they have been high grading for some time.
Yeah. Okay. So with regards to African resources, I would say that definitely since probably about 2 years back, there's been more and more African supplies. And even when we speak with the spot market on a daily basis, we also hear of many offers as well as transactions for African materials in the market. Even I think last Friday, there were also African materials sold in the spot market at 820 on a CIF China basis, converted to SC6. So definitely in the market, we do see that African materials will occupy a larger and larger share in the near future. But currently we do see that because African mines, besides those that are more integrated or already bought over by the Chinese converters, but those like standalone smaller mines, I think the general attitude towards those materials from the lithium converters would be that of caution, because they still prefer a resource that's slightly more consistent in terms of the production as well as the grades. So we have like traders telling us that they are buying from the same mine, but each time they may receive, so there was this trader who received like 3% grade, and then the next time he received like 5.5% grade from the same mine. So I think for the larger part of the market, they still emphasize a bit more on consistency. So that's why in the spot market, we do see that even though African materials, even if they are offered for the same grade, for example, 5.5, but they are still offered at a discount to Brazilian and Australian materials. And the discount could be about $50 to $80 per ton. So that's I think the market attitude at the moment.
Got it. Okay, let's move on to the next question here. There was a chart that was shared by you, Alice, which talked about 25% of the current market being unprofitable in terms supply on the curve. How much of that is lepidolite in your chart or in your estimates, and where do you see this lepidolite cost base sitting? I guess people are trying to sort of understand how much of that might be integrated, not integrated, and is there potential that despite this cattle restart, you actually might see some of the independent guys, shut down or take supply out?
So that chart, we look at like a resource base at the mines that we capture. There is a lepidolite mine in there, but everyone has different cost of production. I think a lot of the third-party material for lepidolite tolling that's already cut is the integrated producers that have to decide on production. Lepidolite is the swing producer, but we kind of passed that swinging stage already. Our forecast for this year is for China's lepidolite production to be flat.
Right. Okay. Let me pick up another question from the queue here. Okay, there's one here for Mun, I think. It's talking about the ESS demand. Mun, can you help us understand the current run rate that you're seeing in the ESS market in terms of demand, I guess the question's asking, and then why do you forecast ESS to run at the same rate as EVs despite having a much smaller base?
Okay. So the numbers that I mentioned earlier come from the team that cover storage systems. Yeah. So I can't speak particular to the underlying at the moment, but what I can say is that lithium batteries right now are the dominant technology in ESS, counting for 98% of the market in gigawatt hour terms. But that percentage will start to decline to about 90% by 2030, still very dominant. So what's happening is a lot of the alternative methodologies or technologies are going to be growing at a faster rate. So you've got sodium ion, you've got flow batteries, and you've got the non-battery types, which include things like pumped hydro, thermal, compressed air. So I may have to come back to you on some of the underlying from the team itself that does the forecast here. Yep.
Got it. No worries at all. Next question here is perhaps from a local Chinese client. They seem to be close to the news flow, but the question is around the pickup in lithium demand from trucks. So there seems to be a bit of a demand that's showing up in terms of conversion of trucks into electric battery-based systems. Do you guys have a view on what that could translate into in terms of demand, and is that captured in your supply-demand models as yet? I guess commercial vehicles, electrification.
Yeah, I think it sounds like the question might be asking about converting like an ICE truck to EVs. I think that it's actually when you build that system, it's quite easy to swap out, and it might help with some of the ESG credentials of the fleet. But that is not like that is not like a common is case by case, but we do forecast commercial vehicles demand, and actually a lot of the demand in that other segment that was on the chart comes from commercial vehicles. It's easy to switch for commercial vehicles because it's usually government mandated, and it's easy to set out the charging for it, and the battery size are very large, so the effect on lithium demand is much bigger on a unit basis.
Got it. Okay. I've got two questions left here in the queue. I'll remind the audience we're at about the 45-minute mark. So if we don't have any further questions after these two, we'll close the call. So if you're holding back any, please do send them through now, and we'll try and take them up. Next question's about inventories through the chain. I guess that's an interesting question because we haven't really talked about that today. Any views on inventories through the chain? I guess battery producers, spodumene, EV inventories. I guess let's do a quick around the grounds on that. Leah, with you starting.
Yeah. Okay. So earlier I shared that the average inventory level is about 2 to 3 weeks. So that would be roughly mostly at the lithium converter side. So we've heard like one of the major lithium converter, their current inventory level is about 3,000 to 4,000 tons of LCE equivalent. Yeah. So that's the numbers that I'm hearing from my side.
Got it. Okay. And any other anecdotes at all in terms of inventory in other parts of the chains, mine sites, EV inventories, wholesalers, retailers on the EV side? Anything interesting that you'd like to point out besides that?
For my side, we've just spoken with a Chinese cathode maker earlier in the morning, and he did share that his current inventory level is also around 2 to 3 weeks. So I think that's roughly consistent throughout the supply chain. Yeah.
Got it. Okay. All right. And then I will take the final question now that I have here. What is your long-term lithium price assumption and how is it determined? Is it relevant still to do an incentive price analysis, given large companies are now getting involved in lithium like Rio Tinto, and with a large part of the capex being sunk, the operating costs might actually be quite low? How do you answer that one? Perhaps that's for Alice.
Yeah, for the long-term price, we look at the market balance. So we look at the cost of projects that is coming online, and also we consider the lithium resource base, government investment, etc. The fact of the matter is, lithium is pretty abundant. The problem is, especially in North America, is developing the technology that can extract lithium economically. Now, we haven't seen lithium investments slowing, even when prices have dropped. Like lithium, surprisingly, still makes the top headline like every other day, despite the price environment. I wouldn't say a lot of the capex is sunk. I think there's like ongoing, like these projects, especially at Rio Tinto's, some of their like Jada project, you need ongoing capital investment for it to be brought into production. And I say for the novel deposit types or novel jurisdictions, you need like a longer pipeline, more commitments. So I wouldn't say they are sunk. We did look at closures that can restart quickly, and we factored that into the price forecast. Well, those don't need a lot of cost to bring it online again. But for like actual greenfield projects, they do need continued investment.
No, understood. And also, I'd highlight, the capital intensity for some of these DLE-based projects is still pretty high. So the longer you have a lower lithium price, I guess, the longer you potentially see some delays continuing in terms of new and fresh investment. And I guess the long term automatically then somewhat looks better. 47,500, I think, was the per ton capacity cost for the Rincon project, if you take into account the early study works that Rio Tinto carried out. So pretty steep, and if you're going to make an IRR on that, it means you need a lithium price that's definitely higher than where we are today. Look, that's all the questions we have today, team. I'd like to thank you all for joining me. Obviously, an absolute pleasure to host you guys as always, and sessions like these are very informative and valuable for our client base. I also want to thank everyone who attended today and sent their questions through. Really appreciate you guys keeping the session interactive. This does conclude today's call. If you have any questions, please send through to either myself or the S&P team here, and we'll be in touch offline. Before I close, just for Alice and team, a few requests have come in on chat right now to send through a soft copy of the slides. So if you have those, maybe share them with me and I'll share them with clients. But thank you again, Mun, Alice, and Leah. Hope you have a nice day and catch you guys next time. Thank you very much.